Hello, I'm Ken Leon, Director of Equity Research at CFRA, and welcome today to Technology Investing Growth versus Value Debate. We're really excited for this webinar. Technology is top of mind for many investors, and we have a great team. Also with us is Dawn Bang, who's steering the ship in marketing, both for the event and for moving the slides. Next slide, please, Dawn. Here's our standard fare disclaimer. Please take a look and read. Great. Next slide, please. So with us today are our technology team, which have decades of experience going through different cycles of the market, and for technology, they have really tremendous backgrounds and insights about the specific industries and companies that they cover. We wanted to do something different today, which was to have a webinar where it was almost a debate or a discussion about growth versus value. We take this webinar, instead of it being one-way linear, we take the midpoint, and then we have a Q&A or debate, and then we'll finish up with company recommendations. But we're really excited to have this team. It's a great team to give insights, and obviously with the weighting, the size of technology to the overall market. Let me just do one or two slides on who CFRA is. Next. So this is our timeline. CFRA has really a great reputation in the market. We're a global firm, one of the largest independent research firms, and our firm really began to scale out from its genesis of forensic accounting to fundamental research with the October 2016 acquisition of S&P Equity and Fund Research. Since then, and in the last 2 years, we've expanded with the acquisition of First Bridge Data, which has given us enormous capability in terms of data and analytics for ETFs. And more recently, in 2021, the acquisition of Lowry Research, very well known in the marketplace for technical research. Next. So our fundamental research is really driven by our analytical team, and also our ability is to provide those deep insights. And with our scale of covering 1,500 companies global, covering all 11 sectors and 68 industries, like today, as we go through the technology sector and the sub-industries in technology, our team is really in a great position to look at trend, to look if there's disruptors, to see if there's something episodic that will change the investment framework. We also collaborate with our forensic team in terms of accounting issues. All of that brings to us really a great position for thought leadership that also extends from company research to ETF and mutual fund and sector research. I do want to point out, as you're going through this webinar, that you can ask questions on the chat function. Do not be bashful. We'll try to get to those at the very end of the webinar. Next slide, please. So, Angelo, Zino, please kick it off for today's agenda.
Great, thanks a lot, Ken, and hello to everybody on the call. So as far as the agenda, I'll start off by giving a quick update on the broader IT sector. We'll then pass the baton over to John Freeman, who will talk about growth investing within technology. He'll then pass it back over to me, and I'll talk about value in tech, looking at what works and what doesn't. And then we'll get David Holt and Keith Snyder into the conversation and debate growth versus value within tech. Finally, we'll highlight some of our top picks within both the growth and value spectrum. So on slide 8 here, I just want to start off by giving a quick overview of where CFRA stands today as far as broader tech is concerned. After several years of being overweight tech, we downgraded the sector to market weight last November. Number of reasons for that, biggest being the high multiples expectations for the group, while at the same time, the sector was going to see earnings grow below the broader market. So you can see from the table here that before the start of earnings season back on April 2nd, IT sector earnings for 2021 and 2022 was 14.7% and 13.8%, about 710 basis points and 190 basis points below the S&P 500. Q1 earnings season, very strong for tech, but the EPS beats were largely expected, and the market essentially shrugged those gains. Now, post Q1 earnings season, IT sector earnings growth has been revised sharply higher, with expectations for EPS growth of 22.4% in 2021 and 11.3% for 2022. Now, despite those big beats in tech, broader market had even larger beats. Now, looking ahead, tech does have a higher bar to beat than the rest of the market, and you'll definitely see the tough comps have a negative impact on growth trends here. In addition, the money flow up until recently definitely has favored value sectors where the reopening theme remains the central theme, while a possible rising interest rate environment, Fed tightening, does potentially pose a headwind on tech, at least in the near to intermediate term. Longer term investors, in my view, though, shouldn't worry about any of this, actually should embrace the volatility, tech underperformance, if it comes from any of those themes that I just mentioned, as the secular themes really remain more powerful than ever. And we can talk about the cloud, AI, 5G, security, a host of stuff. Now, the next slide here, just quick chart on the performance of the IT sector, which is blue, versus the S&P 500, which is red. You can see the outperformance in tech from the pandemic lows through late last year. However, the tech euphoria really peaked back in February, as did the hype surrounding growth across the market, especially post Q1 earnings season. Looking at the chart at the bottom half here, you can see the underperformance in tech versus the 500, and there very likely could be more room for underperformance in the coming weeks and months. And despite that recent relative underperformance, it really is just a small blip for those long-term investors dating back here on this chart back in 2018. Actually, since then, tech has outperformed the S&P 500 by more than 40%. And really, the way I look at tech in terms of the recent performance is that you're really just digesting some of that multiple expansion you saw last year as growth rates come down to more normalized levels. Now, here on slide 10, when people think about tech, they often think about the FANG stocks. And while FANG clearly important driver of the market and important to our daily lives, there's a lot more to tech than FANG. And for the sake of this presentation, we're actually going to look at tech from more of a sector level. And before we actually start having that conversation of growth versus value in tech, it makes sense to drill down the sector composition by sub-industry. And if over here, you've got the 6 sub-industries. Software today dominates IT, 31% total representation. And you can see some of the bigger players here: Microsoft, Adobe, Oracle, Salesforce. Next, you have hardware and semis. The more cyclical areas of tech represents about 43% of the sector. And then the other big component, IT services, led by Visa, MasterCard, PayPal, among others. And then finally, you've got comm equipment in terms of Cisco and those electric equipment and instruments, about 2%. So the two smaller groups, about 5% of the representation there. Next chart here, slide here. I just think this slide does a really good job breaking out how each sub-industry within tech is constituted when looking at growth versus value. Now, the chart on the left looks at each sub-industry on an equal weighted basis. Using this approach, about 2/3 of the names within the tech, which is that top bar, viewed as growth names, 1/3 value. The industry most exposed to growth, not surprising, is software, while the hardware, storage, comm equipment industries are where the majority of the value names reside. Now, looking at tech from a market cap perspective on your right, you can see IT definitely more concentrated on the growth side of things, more than 80% exposed. Apple tilts really the scale here to growth on a market cap basis for hardware and broader tech, while software and services continue to just increase the tilt towards growth on a market cap basis. Again, this is more along the lines of the bigger taking a bigger piece of the pie in tech. And here's my last slide before I transition it over to John to talk about growth. Just quick table on performance and multiples of tech versus the 500 at the top, and then by sub-industry below. On a sector basis, IT has underperformed the 500 by about 700 basis points year to date, but on a longer term basis continues to reign supreme. 3-year tech was up 97% versus 54% for the 500. On a PE basis, the PE trades at about a 14% premium to market. That's really come down here over the last couple of weeks, and it's garnering some bottom fishers into the market. In February, this premium actually was north of 22%. Now, by sub-industry, comm equipment performing the best, hardware the worst, but ex-Apple, hardware actually the best performing industry, up north of 25%. Again, demonstrating the significant outperformance value has had versus growth year to date just within the tech sector. Some of the larger cap names in software, semi-services, definitely been a laggards this year. However, going back to 3 years, those high growth areas have clearly been the place to be. And we think on a longer term basis continues to be the place you want to be. Now with that, I'll actually pass it over to John, who will go into growth and tech.
Thank you, Angelo. Appreciate it. Good morning, everybody. My name is John Freeman. I cover software and communication and the communication services internet names, as well as the video game publishing sector. So if you look at, the history, right? The history says, and conventional wisdom says, you go all the way back, right? It says that value stocks outperform growth stocks, over time. And so, if you really dig into that and why that's the case, it was basically the idea was that value stocks were safer, right? They're not going to, they're less likely to lose a lot of value, right? Whereas growth stocks with their, with their S-curve sort of a growth pattern, right? If that S-curve doesn't, if that growth rolls over sooner than people expect, then you have considerable multiple compression and you have a lot of losses, and so that was kind of the dichotomy historically. If you look at since 18 on this chart here, quite clearly growth has outperformed value. But so the question is this just a reversion to the mean? I mean, it actually goes back. Don, if you could roll the next slide, please. So the multiple compression that you see now, just very recently, right? Is this a buying opportunity, or is the reversion to growth, over, in the face of the history, is that just a reversion to the mean? Are we just being fooled by randomness, right? Or is there something underlying growth now that's different from the past, and therefore makes growth a more attractive place to be going forward relative to value? So next slide, please. So here you can see this is the gap. It goes a little bit further back to 95. You can see there was obviously a pop where growth outperforms value and then comes crashing right back down and reverts to the mean in 2000 with the telecom bubble and the dot-com bubbles bursting. But since 2008, since the financial crisis, the gap has widened substantially, and it appears, it feels like a pattern. So why is it, is there a fundamental reason? I think there is. I think that fundamentally growth, historically has had a lot of, there have been a lot of catalysts for growth stocks. But now what you really see, it's all software. Right, it's predominantly software, and even in non-tech companies, it's software that tends to be driving the growth. A company like Uber, for example, is a software company that just happens to use what it does in a different, apply its software in a different sector, in a different business. It didn't sell its software to taxi cab companies. It decided to be effectively a taxi cab dispatch service, right? So that's a fundamental difference. The other portion of this that's different is there's a lot more recurring revenue with cloud computing now. So that recurring revenue tends to be a lot stickier and with a lot more pricing power over time. The growth, the S-curve that I was talking about, is less steep, but it has long duration. As you can see, like Salesforce.com, ServiceNow, these companies have been growing consistently, just on the top line, more than 20% a year. For Salesforce's case, it's almost 20 years now, right? So I think that actually puts a different floor, right? So you get the growth, but you also get a measure of safety, at least for those cloud companies that have, that have gained traction, that are of a certain size, and we're talking about mid cap and large cap and mega cap names. Next slide, please. So there's a number of reasons, kind of the whys behind the why here, that I think underlie why software and why growth, why software is dominating growth, and why that matters, why that's is really a different change and makes growth safer and more attractive going forward. So there's a number of developments, but the fundamental reason is because software is recursive. Like if you have a good software ecosystem, that just simply begets more software, right? And more innovation and more growth. So if you look at the largest 5 U.S. companies by market cap, right, 76% of the businesses, the 5 largest are all software based, and like 76% of all businesses in the top 50 are based on software. Back in the 90s, the maximum of tech investing was you wanted to buy the pickaxe and shovel suppliers, the Ciscos, the Microsofts, the Oracles, Sun Microsystems, and you wanted to avoid the dot-com gold miners, right? Because searching for gold is risky. Well, what's happening now, the way I kind of think about it, is a lot of these companies are using software. They've developed a great pickaxe or a great shovel, and instead of selling it to other miners, they've decided to search for gold themselves. And that gold, is in the form of, taking share in the advertising industry, the music industry, transportation like Uber, and so forth. And you can see all down the line, these companies are taking share. Now, so what that means for other, the rest of the businesses that are not software based, well, they got to buy more software from other companies, and they have to, really, and that's, part of the digital transformation sort of movement. Take software and substitute it for labor and capital, and therefore, leverage the power of software to quickly scale and so forth. So if you look at when I say software is recursive, so if you look at these ecosystems that have developed, they're incredibly, they're becoming incredibly complex, and a lot of these cloud companies have the other cloud companies now as kind of partners and and companion. There's sort of a co-opetition, but you see a lot more cooperation now, and a lot more sort of API based integration of applications, which is incredibly valuable to the customer. And so that propels growth and kind of has a mutually reinforcing aspect to it, right? And you have this obviously with subscription-based pricing and the revenue layering, you have a longer ramp, but it is much more solid and longer duration. Which you also can take out, and was a lot of the bias, I think, in the value preference previously, was the big market downturns in the 30s and in the 70s that really punished growth, particularly growth that wasn't based on software, and things, and even in the 90s, all of those PC makers, right, they all became commoditized, right? That happens routinely in non-software businesses, whether they are tech or not, right? So that happens. So that's why, I think the software is where you want to be in growth, and in particular, you want cloud software that is being sold as a subscription, and you have that recurring revenue base, and also the tremendous operational leverage and margin expansion that you get with cloud companies that you haven't really quite seen yet. I mean, you see it here and there, but you definitely see it in any of these data center hyperscale based businesses like Facebook, or you see it with Salesforce. Whenever they whenever they need to, and they have to, they can pull the lever back on expenses, and they pop margins very quickly, right? So there's a tremendous amount of latent margin expansion that I think is in growth in tech, and in particular these cloud these cloud application providers. One of the if you look at a classic software company, right, a traditional software company that sells licenses and maintenance, you typically get a big boost of growth and then it kind of levels off. And you also have a leveling off of operating margin right around 35% to 40%. That's not the case with cloud. There's no cap on that. I think you can, although it's not completely comparable, I liken it to Visa, which is, essentially operates a cloud business that happens to be transaction based, right? But Visa's operating margins are north of 60%. I think a lot of cloud companies will continue to expand operating margins over time, much higher than people, may have expected. Next slide, please. So this is kind of a visual that I like to use to talk about. So why is, what's the why behind the why behind the why? And it's Moore's law, right? And Moore's law is the doubling of every 2 years since the 60s of a cost constant doubling of transistor density. Effectively, it's computing capacity, right? And so what happens is that has an outsized effect on software. When you really get moving and you have a lot of transistor capacity, you can do a lot of stuff and you can, develop a lot of software. In 1975, you just didn't have enough. There just wasn't enough transistor capacity in any computer really to do that much, as much that was useful. But the stuff that that which was useful was adopted very quickly. So there was a high, sort of marginal increase, right, in performance and in value delivered. So this kind of just shows that and this is not going to stop. I don't believe this is, Moore's law may be slowing, but it is certainly not stopping. And it looks like I believe it actually might even accelerate. But it doesn't have to, because there's plenty of every 2 years, even every 3 years, if transistor density doubles, that gives the software industry a tremendous amount of capacity inside with which to grow. So anyway, that's kind of my take on growth and software. Back to you, Angelo.
Great, thanks a lot, John. So on slide 20 here, I'll just go through some of the key characteristics to look at when considering value in tech, of course, driven by legacy tech, cyclicals, hardware. You could see some of those other characteristics really driven by many other value areas of the market, slow growers, if at all, below industry margins, known cost cutters, stable cash generators. Many have heavy debt levels, low PE multiples, and a key reason investors have value in tech in their portfolios is the lower beta volatility they typically possess, often the anchors in your portfolio, but also be mindful that some of these value stocks tend to also be more volatile inside tech, like memory companies that have much lower earnings visibility through cycles. And then finally, value typically has those higher yields, right? So most of us really know what constitutes a value stock. I think what's more important inside tech is when does value investing work and when does it fail inside of tech. So in my view, value investing works in 4 different scenarios inside of tech. The first, good timing. Buy at the bottom works great as you get ahead of a massive earnings upswing at depressed multiples. And I'll provide examples here, case studies in the coming slides. Second, we've got underappreciated growth story. In this scenario, you have a cheap stock where they potentially have a great growth story. They may be too small that the market just hasn't caught on to. Third, you've got the turnaround story. Many examples fall here, but typically a low industry grower for years on end that fell to the waistline for whatever reason, old tech, bad management, then something comes along to really change the narrative of the story, often a management change again, or activist that gets involved in the stock. Then finally, you have the fourth scenario, the special situation. Think about the conglomerate discount, HP, a great example here. Can't even tell you how many companies have really morphed from HP. A company with lots going on, but the street not properly valuing the sum of the parts in the special situation case. Now, on the next slide, here are just 4, among the 4 examples we provided, by far the most powerful value play is the one that's got the embedded underlying growth story. And why is that? Because it's powerful enough, it really could completely transform the company and how investors value the company, essentially re-rating that underlying multiple that investors give the company. 3 examples are here, all companies I'm sure you've all heard of. We're recommending all 3 at the moment. By far, my favorite part of the job is looking for these type of situations. But of the three situations, the most recent is Apple. It's trading at less than 13 times. Back in early 2019, the stock had corrected more than 40% in a 3-month span as the company said they were going to stop providing unit data for its hardware businesses. And then subsequently, they provided their first pre-announcement since the launch of the iPhone. And at that time, there were definitely concerns about their struggling core hardware business, but that all proved unwarranted. And it actually allowed their higher growth, higher margin, more recurring based service, wearables type businesses to really shine. And as a result, that story really gained traction over the next 2 years, and the story got re-rated. Microsoft, another great example, back in 2013, trading less than 11 times earnings. Everyone hated the company, and you had a new CEO take over, focused on the transitioning to the cloud, and we can kind of see what's happened here over the last 8 years or so. The company has essentially seen a 7 to 8 time increase in its stock, and largely due to the revaluation, re-rating of the company. And then finally, you've had AMD, sub $2 stock back in 2015, now up nearly 50-fold here over the last 5 years or so. But at the time was a CPU, GPU provider, kind of lost its ways, only alive because Intel couldn't have a monopoly in the market, but its new CEO at the time refocused their efforts more on cloud servers, and of course the company's initiatives at the time were ideal given the cloud adoption that was about to shape form here in the following years. Now on the next slide here, this is just the other three instances where value does work, in our view, could also yield some very substantial gains. In terms of looking at cyclical bottoms, Micron, and again, all three of these names are names we're currently recommending. Micron historically been a great way to play the game because cycles go up and down so frequently in the memory space, often the most commodity-oriented, viewed as the most commodity-oriented part of the chip space. Prices fall 30 to 50% in downturns, often gives you a time to kind of get into the stock. Every cycle has historically led to higher highs, higher lows. So even if you've kind of mistimed the cycle here, it's always kind of resulted in kind of ahead. In terms of the turnaround story, look no further than On Semiconductor. Among the worst performing semi stocks over the last 20 years, you've recently got an activist getting into the stock and Starboard last year, looking to turn around its business. On has by far the worst margins in the industry, and you've now got an activist and probably the best ever in terms of the semiconductor industry in Starboard looking to turn that company around, and they've done it a ton of times with other companies, Mellanox, Marvell, some of the more recent examples. And then finally, you got the special situation play in terms of Dell, and this is one where they've traded at a conglomerate discount. In fact, about a year ago, when we initiated on the stock, it was given no value for its core business, as 100% of the value was equal to 80% of its stake in VMware. Since then, they announced the VMware spinoff to reduce debt and hopefully start returning more cash to shareholders like other value type of names. Now, in terms of the next slide, this I think just does a great job looking at the history of the chip industry and I think the tech industry overall. So, where essentially shows where we've gone and where we're going. And this chart is broken down into 4 eras. And what's so important within tech is that each new era is bigger than the prior. So in the PC era, it started back in the 90s, helped start the internet revolution with PCs back in 90, only at 25 million. In 2002, you had BlackBerry unveiling its first smartphone, igniting a much bigger mobility era than the PC era. And then in 2018, which is currently the biggest revenue year ever for the chip industry, it'll likely be eclipsed this year, we saw data generated by machines exceed that of humans for the first time ever. And I truly believe that we're now in kind of the very early phases of that AI age, which will unlock very massive opportunities and be by far the most important era the tech space has ever seen. Now, if you're a true long-term tech investor, there's really no need to complicate things. You win in tech investing by getting ahead of these massive transformations. Many value stocks become value because they miss these trends. And great examples are companies like an HP and Intel, both PC-driven companies that, let's say, strived in that era, but were very late or missed the mobility inflection, and to this day are paying the price for missing out. I think an opposite example is a company like AMD, which did great during the PC era, missed the mobility era, but it's a value stock that clearly has the right tools to kind of embark on the AI age, and as a result, the stock had gotten re-rated here in recent years. I think, one other thing I'll point out is a company that's done fabulous across all inflections is Apple. Apple with their PCs, they transitioned very well to mobility with the iPhone in 2007, the iPad in 2010, you had the watch in 2014, and of course AI at Apple is being driven by Siri. They embed everything also they possibly can in AI enabled in their devices. Just think about face recognition as a great example, and in the pipeline, you've got AR glasses, autonomous cars, which we think will allow them to be major players in the AI world. Next slide here. When you think about value or growth oriented companies, I think here's just some extremely important trends to be mindful of as we kind of migrate towards a more AI-driven world, and where machines are kind of doing more of the thinking. The value of tech becomes so much more important. So this goes for software, hardware, semis, services. But this slide here just looks at the semi side of things from a content perspective for select devices today versus where they were 5 years ago and where we expect them to be in 5 years. And this kind of just leverages based on what we saw in the last chart. So for instance, an iPhone 12 has about $170 worth of semi content, and that figure is seen rising to $275 in 5 years. So the shift to 5G clearly leading to a big step up in semi content. Cars, of course, something that's getting talked about a lot. The content growth coming from the shift of ICEs to EVs, and the faster that takes place, the quicker the growth in silicon content comes. And then data centers, of course, is where you're going to see the biggest dollar rise, just given the amount of semiconductor content involved within a data center. And then my final slide here, we kind of talk about what works in tech, probably worth spending just a minute at what doesn't work and why it doesn't. And I think the Intel debate has been one of the focus for many, many years. It's something we get questioned a lot from our clients, is now the right time to finally get into Intel. And as a value investor, really nothing worse than holding that kind of perennial loser on a stock. And this slide kind of takes a look of kind of one of the biggest value traps in recent years, and you can kind of see that on the chart in the top left. Intel kind of hovering above on the x-axis, where then you've got NVIDIA up north of 1,500%, AMD up north of 2,000% since 2016. And if you look at why that's happening, Intel losing market share, technology disadvantage in recent years, that's really what you want to avoid when we're thinking about companies that could benefit on a value side of things from something that would allow them to revalue themselves, and companies to avoid. So this is a company where we continue to see them being at a technology disadvantage and continue to see market share loss. And it's a business model that they're looking to transition here in terms of foundries, which we're not ultra excited about. So if you're looking to get into, let's say, an Intel trade, we think you're just way too early on that side of things. So I think at this time, I'll just pause and I'll pass it back over to Ken, who can kind of start our growth versus value debate.
Great. I want to bring David into the conversation. David's on our model portfolio committees, very good technology thinker on strategy. And David, are you still sanguine on the growth stocks? I mean, we've had, sell-offs. There's been rotation to value. From your position and also your coverage, what's your thinking about growth?
Hey, thanks, Ken, and great question. So just to be clear, we are not actually saying that tech takes back leadership in 2021, and that's really as some of the market cross currents continue to tell you to overweight cyclicals that really follow some of that tight correlation to economic trends. But what we are saying is if you are in it for the long haul, look for some of those more disruptive stocks and use some of these corrections to really add to those names that you have conviction on, or that you believe have a disconnect between the share performance and fundamentals. So also, I think it really helps an investor really establish a hedge to be really aware of their blind spots, say if CPI figures start to slip here, or really that initial burst of economic growth starts to taper off. So secondly, we think that dichotomy between interest rates and tech underperformance is more so on a psychological over a fundamental factor. So is it really a rates question? I would remind people that rates were 7% in 1995, over 3% in 2018, and that's with growth seeing some respectable performance. So obviously the dynamic here is a tad different, but can higher interest rates really compress higher multiples in the near term? Absolutely. Longer duration assets, they really generate cash in the future. Those can be hits, but longer term, some of those names with that indelible business model, and maybe so with that management team that has a steady track record of really exceeding expectations, usually outperform longer term.
Great. So Keith, you finally get a question that's not AT&T. Keith covers communication services and technology. And in technology, Keith, when you think of some of the nascent or strong growers, security or voice communications, where do you see the opportunities? I mean, security has been a pretty big area of tech.
Yes. So, I mean, on the security side, we've seen just a string of high-profile attacks from SolarWinds and FireEye to most recently Colonial Pipeline, and that cost the company $5 million to clear that ransomware. No one is safe in this industry. There's a saying in cybersecurity that there are two types of companies, those who have been hacked and those who don't know it yet. And while I think that saying kind of started as a joke, today it's turning out to be very much true. And so these attacks are actually acting as a catalyst. Companies are re-examining their cybersecurity strategy, realizing they need to spend more on securing their networks. And the weakest link in any security system is actually the employee themselves. Spear phishing is by far the most common attack vector that we've seen today. And companies that are specializing in this endpoint protection, like Proofpoint, which was actually just acquired, Cisco has solutions, FireEye. These are the companies we really like. And so cybersecurity spending is going to go up in future years, and that's a huge positive. On the comm equipment side, again, so many long-term positives for these companies: 5G network deployment, the Wi-Fi 6 upgrade cycle, the move to 400 gig Ethernet switches. These are all very positive trends, and so the sell-off that we've been seeing recently has occurred for very valid reasons. Enterprise spending is down. We're seeing component shortages, which is a very real concern for these companies. But especially with the component shortages, I would say it's an industry-wide problem. So customers can't just pick up and go over to another competitor. Everybody has extended lead times. And so we're seeing record backlog levels. And this gives us a lot of confidence in the long-term health of the comm equipment industry. So, the saying goes, buy when there's blood in the street. And I think that holds very true today. And I definitely would be more aggressive with investing in these two sub-industries.
John, you've gone through multiple tech cycles, .com and others, and how can we get comfortable with valuations in these high multiples? We're in a low inflation period, moving to stronger inflation, rising rates. Multiples are very high relative to historic. What's your take on valuation?
So, yeah, I think obviously I think it really depends on depends on the specific stock. But let's say you take the cloud names as a group, right? Or take those as a group. I think there's a large portion of the valuation, of the multiple expansion that we've seen that is justified, and it is justified because of two of the points that I made. One is the long duration of a cloud, the successful cloud provider that has gained traction. They have a much longer duration of growth than you would have found in a traditional software company that, obviously it's a great business that has, historically, always had a sort of a valuation premium. But I think cloud goes further because I just think the duration is longer, it's stickier, and then also the other aspect of that is that over time, margin-wise, it's a much slower ramp to margin, but it keeps going. That is, it blows through. And in my view, the typical software company kind of would top out at around 35 to 40% operating margin, and that is because maintenance, right, becomes the primary portion of their business. and maintenance is, you know, fairly labor intensive, right? Support contracts are fairly labor intensive. A lot more people you got to hire. You find that software out there in the world, you know, all kinds of different environments and different problems. It just requires more people, lower margin, right? Whereas a cloud provider doesn't have that issue. They operate their software internally, right? So whoever subscribes to it, obviously, might have technical problems, but they don't. It's not nearly the complexity that you have in the traditional software era. And I think you can have I think you can have operating margins that blow through that, and you know, maybe hit the 50s and even into the 60s for some groups. And I don't think that, I'm not sure if everybody has realized that, but I think that maybe, you know, that explains a little bit of the valuation difference.
Yeah, Angelo, and then John. So this question did come in, but I think you can handle it. Can you please expand on the reference to pickaxe and shovel suppliers in the .com era and how it's different today? Angelo?
So I think maybe John, you want to take that first, because I think
sure. Exactly. Yeah, that's kind of the analogy I've been using. So back in the 90s, it was kind of the old saw for investing was invest in the pickaxe, you know, because it was considered a gold rush, right? The internet was a gold rush, the .com boom, the telecom boom associated with that was a gold rush. And what you wanted to do was, instead of being a gold miner, right, you want to invest in the pickaxe suppliers, right, who famously got, you know, wealthy, shovel suppliers of Levi's jeans, right, those guys who sold to gold miners, because most of the gold miners weren't going to make money. That was the issue, right? So you're really, you know, only 10% of them strike gold. But let's say, and so the analogy now, though, I think is different, and I think where Google and Amazon, you know, kind of the original sort of differences here back in 2005, where they just developed all of their own software, and they really don't purchase much outside. So basically, they invented a pickaxe, a great pickaxe to, you know, for e-commerce, or a great pickaxe for, you know, for search. And instead of selling it to somebody for that person to use, they just, you know, decided to employ it themselves in order to disrupt a particular industry. And I think we've seen that over and over. I think Uber is a great example of that. Airbnb is a great example of that. So more and more, right, we see software companies that are not operating in software. And I think that's actually, you know, sort of full circle. I think that's actually another emerging style box. Is, you know, to what degree a company is software based, and to what degree a company is, you know, labor and physical capital based. Basically, what is the nature of their means of production? And I think that's a very interesting way to look at companies, you know, for future growth, right? Rather than simply looking at historical growth rates and so forth.
Good. And then Angelo,
I hope that answers the question. That was kind of that's kind of the analogy that I've been using, is that gold miner analogy and how that's shifted.
Yeah. So Angelo, maybe just a quick one on semiconductors today. A little bit of both, shovels as well as software, and then take it up to the sector level in terms of, have we reached bottom in terms of tech sell-off?
Yeah, I mean, listen, I think as far as you know, some of the chip areas is concerned, and then and on the tech side of things, you know, I think you've kind of seen a lot of damage done here in recent weeks and months. I mean, in terms of the semi side of things, I think you kind of really saw a peak in late February into early March. And our view here is you've seen a lot of damage. You probably haven't seen the end of it. I think what you're in the process of seeing is some significant multiple compression. We've kind of seen a lot of the growth kind of take its path here. I think over the next couple of quarters, what you'll start seeing on the semi side of things is you'll start seeing sub-seasonal growth in terms of a lot of these chip makers. Again, that's probably early stages where some investors are going to think, hey, listen, some of these trends are starting to peak out. And as a result, again, you'll see the multiples compress at this point in the cycle. And I'd expect that to continue through the summer months, until you start seeing the street actually capitulate and say, all right, well, maybe we're near peak multiples or peak fundamentals. And at that point, you probably see enough of the compression where it gets attractive enough to start buying these stocks again. I think on a broader tech side of things also, I think you've seen a good amount of damage. You've seen a good amount of the multiple compression. I highlighted earlier on how, you know, tech was trading at a 22% premium to the market, now closer to 14% premium to the market. And, you know, you're getting close enough, I think, where you're getting those bottom fissures, and you're going to start, I think you still need to see that capitulation type moment. But that being said, I think you need to start buying tech, especially some of the beaten down growth type names, because as we kind of get out of this, let's say, next pullback, as we kind of get towards later into the year and into 2022, I think the focus is going to be more mid-late cycle type of plays, and that's really where growth starts to shine. So that's, at this point in time, maybe still a little bit too early, but you definitely want to start thinking about getting more aggressive.
Okay, Angelo, that was the macro. And David, if you look at the micro, analyzing tech companies, you know, for our investors listening today, you know, how would you distill the approach? You know, what would be some of the steps in this market environment? David?
Yeah, so I love that question. Simply put, go to where no one else is and really gauge if you think investors are being overly bearish or bullish. So if they are, chances are the current or future expectations really follow that similar trajectory. And I mean, sure, you'll have some of those outliers with very large barriers to entry, like your big four hyperscalers or Apple. But that can actually be your first step. And then secondly, develop really the qualitative or quantitative factors that could go into catalyzing some of those fundamentals, or really cause the company to come up short of your expectations. So that really helps establish, I would say, a risk to reward trade-off and the odds of that actually happening. So really combining those two steps, I think, should really help you as an investor either turn up or dial down your conviction on the names that are in question.
So before we get to the company recommendations, David, you know, any slice in terms of, you know, when we look at where are there pockets of growth or tech, you know, where one, it could be oversold, or two, you know, others where they might be exposed for correction, you know, looking at it through your lens.
So I think as you see this stark move with the correction itself, and kind of alluding to Angelo's comments, first, some of those higher multiple no cash flow names were hit, and then some of those semi-high valuations with some earnings were hit. And so now you're seeing some of those moderate valuations with actual earnings power are being hit, and some of those are semi-names. So you see the supply chain constraints, you see the order fulfillment issues. You know, that would be probably one of the areas, at least coming out of this last earnings cycle. And then when you look at just the actual earnings quality itself, that can also be in question. But when you look at the lined items, I would say that right now, and you can see some of the money flow as of today or the last couple of weeks, that you've seen some trickling and some nibbling back into some of your higher growth software names.
Great. So we do have a few questions from the field. We're going to hold them to the hour and take the next 10 minutes, if you will, to go over our favorites. Next slide, please, Dawn. Okay, back to you, John and David.
Let's start with Roblox. My two recommendations are Roblox and Twilio. So one of the things that actually was kind of interesting about that gold miner pickaxe seller analogy, one of the things I left out was, when you have all of this transistor capacity, all of this ability to run software, you know, in the cloud, and you know, run a credit card and start developing, you know, in the cloud an app for an iPhone that might very well take off. We didn't have that before, right? They didn't really have that sort of a platform before, and that now, and what you're also seeing now is actually the emergence of a supply chain, a software supply chain for assembling full-on applications, or in the case of Roblox, games. So what you have with Roblox and with Twilio is the emergence of, they are really software suppliers in a sense. Roblox doesn't make any of the games that make all their money, right? It is a development platform and social network, right? That uses and Twilio is a multi-sided platform as well, being sort of the tie between communication, real-time communications providers for voice communications, video conferencing, and allows developers to just add that to their code very easily. They don't even have to pay up front until they start until their customers, right, start developing, start using the product and generating a lot of traffic, i.e. Uber, i.e. Lyft, that uses Twilio for its communication services. You don't have those kinds of business models that were even possible, right, 10, 15 years ago. But now, with every increase in computing capacity, both Roblox and Twilio really start to shine. And they're multi-sided platforms that have a really strong their competitive the competitive advantage increases, and the operational leverage really starts to take off. So both of these companies we recently initiated on and very much like.
Hey, thanks, John. So onto some of these growth stock picks. But first of all, I really want to be perfectly clear that in writing some of the coattails of previous comments I had earlier, both risk tolerance and overall portfolio composition really need to be considered here. Given both these names might not be for everyone. We think there is value here, but first is actually a special situation, the other contrarian in a sense. So with that disclaimer out of the way, first up is Anaplan, ticker PLAN. So it's a buy with an $80 price target. And I think that's something that we pride ourselves on is really being able to parse through some of the noise by merging some of those quantitative and qualitative factors together to really figure out what's important and really establish a risk to reward scenario. So and that's more so in an unbiased way, or in this case, 3 touch points. And this is on this slide from left to right. So we have the catalyst, or what's really piqued our interest on the left, quantitative inputs in the center column, and then the outputs with our investment thesis on the right. So first up, the catalyst. Deal activity and platform usage has really waned with COVID-19, and we think this is actually temporary and transitory, though, given the step up in billings that you've seen over the past few quarters. In other words, we don't actually view Plan as a typical SaaS play that's thrived through the pandemic. They've had to actually fight through tough comps. So then when you cascade through some of the inputs in the center to really help prove this out, the unique perspective, at least what caught our eye with Plan, it operates in a space with no actual direct competitors. So it's a large and growing TAM of around 21 billion. And that's more so in the enterprise planning and forecasting. Given the shakeups that we've seen since the pandemic, that could be top of mind for some of these companies. And then so when you really look at the investment thesis itself, we like the actual sandbox that Plan plays in. It's favorable setup heading into June Q as they really try to start to jumpstart growth and really lap some of those easier comps. And then last but not least, shares actually trade at a 25% discount to other software peers with similar growth profiles. So moving to slide 31, it's our spin on really relative analysis and ways to look at more cloud-centric names to really sift through value traps, value creators, and overvalued names. So we plotted Anaplan against some of the names based on a efficiency score or out-year sales growth and free cash flow margin, anything with a combo of above 40% being attractive. And really using those metrics really helps encompass all key operating metrics with growth, sales and marketing efficiency, net retention, as well as cash burn. So Plan placed well in the value creator portion of this custom matrix and kind of led us to initiate on the name with a buy. Okay, next we have Cloudera, another buy-rated pick. It's out of favor contrarian name that operates in the enterprise data warehouse or EDW complex with the likes of Snowflake, Teradata, and some of your other hyperscalers with AWS Redshift. So attractive entry point here is really the product of it's volatile, as most of these are, a shift from perpetual or non-recurring licensing to subscription-based revenue. So as you can see from the left-hand chart, once the last of that non-recurring revenue overhang is gone, what really drove that disappointment more recently is they actually missed their 21 outlook because of that revenue drag. But going forward, we actually think the company can gain a more solid footing on sales growth or operating performance. What really drives that dynamic and our rating is the company being able to really change the narrative around being strictly on-prem or with their enterprise data warehouse. With some of the recent success they've had of actually addressing some of those pain points around data latency and the overall usage of Apache Hadoop. So when you really take that a step further and decompose how it stacks up against other peers, and that includes Snowflake, we think they've really been able to rectify some of these issues as evidence in some of the recent success they've had of actually migrating some of those clients to their new platform. So moving to slide 33, any way you really assess this with Cloudera, you have held the upside of the stock. So two key tidbits I'd highlight. For the cost of equity and the present value of the future share price, which is based on a EBITDA multiple here, we've actually incorporated the recent uptick that you've seen in the risk-free rate or the 10-year treasury. So two, much like its counterpart with Teradata, that's already completed this transition and really gained some investor interest earlier this year. Cloudera is part of a cash generative business, and they can actually be valued on an earnings multiple basis, which, as all of us know, other peers in this space really can't at this point in time. So with that, I'll pass the mic along to Angelo to give his value picks.
Great, thanks a lot, David. So the first stock I'll highlight on slide 35, on Semiconductor, it's a buy recommendation, $40 target price. You can see the stock has dramatically underperformed here for 2 decades from that chart on the top right before a massive breakout took place over the last year. Really 3 reasons why we like this stock. One, in terms of turnaround story aspect of this company, lowest margins as I previously highlighted in the industry, but on really embarking on a new outsourcing strategy, which we expect the company to highlight at its Analyst Day in August. I actually think that specific day will be a huge catalyst for the company. But if they execute on this strategy, I think there's significant upside to the consensus margin expectations as well as free cash flow potential as they embark on this more asset-light strategy here over the next 3 to 5 years. I'd also say in terms of the second reason why we like on Semiconductor, we expect them to outgrow the industry by 1.5 to 2 times here over the next 5 years, given their exposure to the right end markets. You can see that in that pie chart, about 60% exposed to autos, industrials. We know a lot of the secular trends, whether it be EVs, autonomous vehicles, and what have you, but it compares to the industry, which is about 20% on average exposed to those 2 areas of the market. And then finally, I'd say we view on as a potential takeover target. There's a number of potential semiconductor deals on the slate this year. We're waiting to see if those deals go through via China. Likely, this one would likely be among the most attractive out there, given its current valuation, potential margin expansion, and desire for more or larger analog companies out there like a Texas Instruments to have more exposure to autos and industrials. So this one could be primed for the picking if the M&A market opens up here for semis. And a second name I'd highlight, also a name we previously highlighted, was Micron. This is a buy recommendation, also $108 price target. Cheapest name in semis and tech. Believe that the volume here will remain healthy and pricing will stay firm through 21 and 2022. Among all the memory companies, Micron's revenue is most exposed to server cycles and less exposed to the more volatile mobility space. It's also continuing to see increasing exposure to some high value solutions with DDR5 offerings that are ramping in the second half and more so into 2022. And that's going to be higher priced relative to its predecessor chips. And at the end of the day, I think from a pricing perspective, the street is underestimating the type of margins and prices that Micron will see here in the coming quarters. I think all in, that's going to result in higher earnings, higher free cash flow assumptions, and the company has done an absolutely phenomenal job improving the balance sheet, and that's going to improve significantly more here in the coming years when we start extrapolating the free cash flow potential. I also think there's also the potential for them to potentially return more of that free cash flow to shareholders. And if they were to announce, let's say, a dividend out there, I think that also changes the complexion of how this company is viewed. But at the end of the day, this is potentially a re-rating story on their ongoing shift to data centers, as well as kind of some of the improvements I just highlighted. So that's it on my end, and I'll pass it over now to Keith Snyder.
Sure, thanks. So starting off Cisco, on the revenue side of things, their customer base is huge, and so this limits exposure to any one end market, and their end-to-end product lineup really makes them a one-stop shop for customers of all sizes, and this is an extremely attractive value proposition for many customers. As I spoke to earlier, security is a top priority for every CIO at every company, and Cisco's security segment is experiencing very strong growth, and it continues to add functionality to their offerings through tuck-in acquisitions. In terms of beating consensus, Cisco's incredibly consistent. Their last miss on the revenue side was 29 quarters ago. So they've had 29 straight quarters of beating both EPS and revenue estimates. And very much a story of under-promising, over-delivering. Their balance sheet is rock solid. That $30.6 billion in cash gives them a lot of flexibility in terms of M&A. They've completed or announced 21 acquisitions since the beginning of 2018. And this has really allowed them to expand into the higher growth markets while also maintaining their leadership in their established markets like the switching market, the routing market. They're also very committed to shareholder return. Between 2017 and 2019, they spent $42 billion on share repurchases, and they reduced their share count by 12%. And then, as I alluded to, there's so many positive trends working in their favor: data traffic growth, the increase in cybercrime, 5G network deployments, Wi-Fi 6. All of these things point to higher spending with Cisco. Moving on to the next slide, Corning. This is another case of just a very strong company. Like Cisco, they're very dedicated to shareholder returns. Since they introduced their strategy and capital allocation framework in 2015, they've increased their dividend per share by 67%, and they've reduced their outstanding share count by 37%. And so these are not insignificant numbers, and they remain committed to that shareholder return. On the optical communication side, data traffic growth and the demand for high-speed connections is forcing the service providers to push fiber connections further to the edge of the network. We're seeing, offerings of gig speed internet, direct fiber connections to your house. Traditional copper lines simply can't handle this data traffic. On top of that, we've seen governments worldwide pushing for broadband infrastructure investment. The White House is calling for $120 billion to bring high-speed internet connections to all Americans. The UK launched a £5 billion internet project. The European Commission is calling for 135 billion euros to support the rollout of broadband services. There's a lot of investment in broadband infrastructure that's kind of being led by governments. In terms of display technology, average screen size continues to grow at about 1.5 inches per year, which doesn't sound like much, but from Corning's perspective, a 3 to 5% increase in the diagonal screen size translates to a 6 to 10% increase in the amount of glass in that screen without any unit volume increase. And so as screens get bigger, the glass that's required grows at a non-linear rate. And so they're the leader in what's called Gen 10.5 plants, and these plants are optimized to produce 65 and 75-inch panels, which in the most recent years have become the most popular panel size. Specialty materials, they've grown sales every year since 2016, despite smartphone unit sales being flat or down for these years. And so that really comes down to both an increase in smartphone size, but also the use of glass in both the front and back of the device. They're also exploring a lot of additional use cases for Gorilla Glass, especially in automotive. Mercedes-Benz actually just announced their new Hyperscreen dash on their new electric vehicle, and that's going to be a 5-foot wide piece of Gorilla Glass for the entire dash. And so this segment in particular has been extremely strong. And then, other use cases, there are other areas of growth. The life sciences, they make all the containers for the COVID vaccines. They make ceramic gas particulate filters. So this is just a company that has its fingers in everything and really is posed for very strong growth. And so with that, I'll throw it back to Ken.
Great. Thanks, Keith. Time for maybe one question or so. Angelo, this question was about Uber, but it's, for dominant companies in their space, have operating losses for long periods, might be valued price to sales or total enterprise value to EBITDA. Is this a good time to buy strong companies in their markets or not?
I think it depends on, what industry, what company we're talking about, and, to what aspect we're talking about. I think, all else equal, I mean, if we're kind of looking very high level here, I think this is a great time to be buying kind of the market share leaders out there, the market share takers. And I think, personally, Uber, I think is a great example of a company that's been hit as of late for its own, industry related type of events, where you've got an opportunity to really kind of buy as their fundamentals start to improve. But I think, at the same time, there are also some of these big bellwether names that are going to have that have performed very well during the pandemic, that are going to have maybe its challenges here over the next couple of months in terms of exceeding very high expectations. So you also want to be careful from that perspective. So I think it all depends, to be honest with you. I think in the case of Uber, though, I think this is a great example to buy a market share leader with a name that's pulled back significantly.
Great. And John, final word on cloud computing. Are we still bullish, and what do you like?
Yeah, absolutely. I think one of the things that people ask me a lot, and is a very sort of legitimate question, is we've been hearing about cloud computing now and software as a service for a long time, at least since in terms of investors' mindset, since the financial crisis, when Salesforce.com, the post-financial crisis, really started to take off, and so so I think these crises tend to accelerate the adoption of the new, and in this case, cloud computing is the new, in quotation marks, but other people realize the size of the migration, right? So if you look at 2019, according to IDC, cloud computing revenue was precisely 1/3 of the total enterprise software revenue, which is, that I thought it would have been a little higher if you total it all up, but it's moving fast. And, by our calculation, in 2020, probably moved up to about 40%. And so, but the point is that even at 40%, that means 60% is the, legacy traditional license revenue and mostly maintenance revenue, right? Maintenance and support revenue that's going to get, replaced and expanded over time, because cloud is is short-term deflationary but long-term inflationary, because you have pricing power. So long story short, I mean, I think cloud computing still has the trend itself has a lot of legs. And even after everybody kind of goes cloud, I think because it's so easy to integrate with APIs and so forth, it will be even more, like as I was saying before, even more recursive. So software begets software kind of thing. And so, I think that cloud computing is definitely on the software side where you want to be. And yeah, I think that you can see it in Microsoft's results and Adobe's results and all of the companies that were traditional software companies that have converted to cloud subscriptions, right?
Okay, great. Dawn, let's do the wrap. Next slide, please. I want to thank our technology team for just a great webinar today, insights on technology. And also want to thank you for joining us today. To get more insights about our research, you can go to our marketscope.com And certainly we have upcoming webinars as well. I want to thank you for spending your valuable time with us. Please stay safe and healthy. Thank you.